Hi, today we're going to talk about the difference between eligible and non-eligible dividends. When a shareholder receives a dividend from a corporation, they pay tax at their marginal rate, but receive what is the equivalent of the amount of tax paid by the corporation as a dividend tax credit that reduces their tax bill on those dividends. In the case of an eligible dividend, these come when an investor buys shares in a public corporation, for example. These corporations pay tax at what is known as the general tax rate, which is anywhere between 26 and 29%, depending on what province they're in. And when they pay dividends out of the net after-tax earnings of the corporation, the shareholder receives these, and these are known as eligible dividends. These have a higher dividend tax credit, and the recipient will pay tax anywhere between 19 and 36%, depending on which province they're in the highest marginal bracket. Non-eligible dividends come from Canadian-controlled private corporations which pay tax at a very favorable rate of anywhere between 13 and 19%, depending on which province they're in. When the corporations pay dividends out of these after-tax retained earnings, the recipient shareholders get a lesser dividend tax credit, hence called non-eligible dividends, because the corporation is paid less tax. The tax rate on these at the highest marginal bracket is anywhere between 27 and 38%, depending on which province they're in. So how can NexGen help? Well, our corporate class mutual fund structure turns every investment into two, not one decisions. You pick the fund that meets your risk tolerance, and then you pick our tax class, which meets your tax objective. One of our tax classes is our Dividend Tax Credit Class, which is intended to provide you with a monthly flow of eligible dividends which come on a per share basis each and every month. So with NexGen, you get to pick your risk tolerance and your tax treatment. Hope you found this useful, and we'll see you the next time.